Afternoon. Welcome to the Blue Line Metals Edge here for Thursday, December 16th. I'm Phillip, Streible, Chief Market Strategist at Blue Line Futures. Haven't done a video in a little while here. Been doing some traveling. Got really busy. I'm rehabbing a house too, so it's it's funny. I try to do a couple of them, and all of a sudden they start jackhammering over my head here on the concrete wall. So crazy. But anyways, getting into it here. A lot of good movement here after it's been kind of a dog for a couple weeks, specifically on the metals contracts. We had silver down. It was like 22 days. We were down 16 of them, and the up days were hardly anything. So if you've been talking with us closely, reading a lot of research, we kind of felt that this latest FOMC meeting would be the capitulation point, and I think that's what we got here yesterday. So kind of digging into the wood, looking at, the Morning Express, just highlighting one of the sentences out here that we're looking at is on, you go down to the gold section and, just what we said here, we thought that we could be on the onset for peak hawkishness, that the Fed, they can't hike 3 times next year. We at least just don't believe that they will. They're saying they are. Some analysts are pricing it, but what I think they're actually doing is they're confusing a couple different signals. They're saying like they'll raise rates in March, April, and then out in like November. I think they're getting 2 of them kind of mixed up, and the dot plot is making where they can have multiple, but really I think it's just 2 interest rate hikes if they can get that. So 3, then now it's only 2, and it ends up only being 1. A lot of it has to deal with complacency in the labor market. Their new Fed policy, so they look at the bond purchase program is one tool, and interest rate hiking is a second tool. They're independent of each other. They're taking the bond purchases, they've accelerated that, they want to get that taper out of the way. I understand what they're doing there. Now, when they come up with interest rate hikes, the problem they'll have is the complacency on the labor market is going to prevent them from getting to full employment faster than what they've been trying to do. Remember, how many of these labor reports that have come out on a monthly basis have been really disappointing, so I think they'll continue to find that disappointment there. Now, you look at a couple things going on the central bank side here today. We did have the UK, they came out with their official bank rate hike. What they did was the Bank of England, they raised rates. It's the first time they've done that in quite a while. You also have the ECB. They are going to modify. They're not going to be as accommodative as what they were, but they're definitely not in a position to raise rates because they're just too big of a landmass, too many different ideologies when it comes to lockdowns and everything. So what they did was on the dollar index, it put a peak in yesterday. And then we've been coming off today. If you've been working closely with me, chances are you've been long the dollar for people that'll do that. And then we took off a lot of them here today. Now coming back to performance data, looking at futures performance, if you go to year to date and you look at futures performance, it has been some of the worst commodities have been the ones that we focus on, like palladium, silver, platinum. They've all been pretty terrible. Australian dollar is another one. Gold. These have all been bad commodities on the year. It's because the reflation trade has really picked up. But if you look, on the day here, the best performing commodity, palladium, silver, platinum, and I really think that a lot of people believe that we could be coming into this period where the Fed wants to raise rates, but they can't because the growth is starting to slow down. Jerome Powell made a big mistake back in 2018. He went and he got much more hawkish into an economic slowdown, and it caused a lot of problems out there. It caused problems with the stock market, and they actually gave up all their gains into the end of the year. So I think that he acknowledges that, so he's going to be a little bit more patient. So going into the charts here, a couple things on silver. A lot of people were adding on this sell-off, pretty much all the way down, and it came in. There were 2 really things that stood out. When we got closer to $25, I saw the producers, the mining operations, they sold very heavy on the future side. They were doing a lot of hedging. And you have to understand for them, they were very concerned that there might be another COVID variant, which we are witnessing right now, although it's not as bad, at least that's the way it's perceived. But they were very concerned over Delta. Now with Delta behind them, they don't want to play that game again. We got close to 25. They shorted futures. Why would they do that? because of the fact they can lock in the price of silver where they want. Remember, their costs minus where the price of silver at equals their profitability. It's a lot easier for them to go and try and renegotiate labor costs, insurance, with energy prices coming down, that they are able to control those variables with their input costs, but they are not really able to control the price of silver. So I understand why they were doing, why they were hedging. Now as the price comes down and as it bled off, you can see on the commitment of traders report, they reduced that. Now it also went and corresponded with futures traders and managed money getting less long as the price went down. So people were over leveraged, they blew out of positions, they gave up. Now yesterday we saw a capitulation. You go back again, you're going to see right here it says peak hawkishness. That often corresponds with these points where there are these inflection points on the chart here where we get these key reversals and everything else. So when I called people yesterday, told them, hey, silver's at 21.50, most people were jumping on it, they were adding to the positions. I think that this easily paves the path for silver to go up $23, $24 without any headwinds coming in again from producers selling. So looking at gold, a little bit different of a story here. On the gold market, the funds are really kind of mixed. Much of them are selling closer to 1800. They're taking shorts, thinking that yields will rise. And then others did cover those shorts between 1760 and 1750. So they might try again and short it right here. I'll tell you the spot where I'm hearing that they would go to neutral trend would be somewhere closer to 1820 to 1830. That's where their stops will be at. That's where the algorithms will flip. They'll go back to neutral. You get a breakout over 1835. They'll probably stick their toe in the water for the long side. Now you look at yields. Yields totally do not believe that they're going to raise it as much as they are, because you could see that they're starting to creep back high. The yields are going lower. Treasuries are going higher. Bonds are also doing the same thing. So, and if you look at U.S. equities, they're a little bit confused too. Selling off right now, you get the NASDAQ under a lot of pressure. That thinks that yield's going higher. So a lot of tug of war around yields. You might have some central banks that are over in other countries that are seeing, like the Bank of England, take charge, raise rates. Then you might see like Swiss National raise rates one after another after another. That's going to kill the tech market. So that's at least what they're thinking, at least what I'm seeing. But this does give the way for commodities to make another run up. So you're seeing all your agricultural commodities go up. You're seeing your energies come back up. Although the energies, I think that the rally is a little bit shorter lived. It won't be able to go up because there's just such a green energy initiative and they're fighting this carbon and everything else. So if you have any questions, give us a call, reach out. Remember, futures and option trading does involve risk of loss. May not be